Hey everyone, and welcome to this explainer. Today we're diving straight into the mechanics, the risks, and the potential rewards of the Bandhan Small Cap Mutual Fund. Look, whether you're a seasoned investor or you're just starting to look beyond the safety net of large cap stocks, understanding exactly how a fund like this operates is absolutely crucial. So we're going to unpack the data, look under the hood of their investment strategy, and figure out what really drives their numbers. To help you assess if this fund aligns with your goals, here is our roadmap for today. First, we'll define small cap funds. Second, look at historical performance and volatility. Third, break down risk metrics and distribution. Fourth, compare peers and benchmarks. And finally, go over the advantages for long-term growth. All right, let's kick things off with Section 1, Defining Small Cap Funds, the emerging engines of the economy. So if you're a conservative investor or maybe just starting out, you might be wondering what exactly sets a small cap fund apart from the rest of the market. I mean, we hear about the Nifty 50 all the time, right? Those massive established corporations. But where does the real raw growth happen in a rapidly expanding economy like India's? Well, the crucial point here is that small caps are the emerging companies. We're talking regional champions and niche manufacturers that simply haven't hit mainstream institutional radars yet. Per SEBI regulations, a small cap fund actually has to invest at least 65% of its assets in companies ranked 251st and below by market capitalization. These are the businesses driving domestic demand and infrastructure expansion. Sure, they're smaller, but man, they carry an explosive potential for growth. Moving right along to Section 2, Historical Performance and Volatility. This is where we weigh the promise against the reality check. Take a look at this number. The fund manages a massive 31,103 crore rupees in assets under management. That is a whole lot of investor trust, making it one of the largest pools in its category. And when a fund manages this much capital, it really tells us two things. First, investors heavily back the fund managers here, notably Manish Gunwani and his team. But second, it introduces a massive liquidity challenge. Deploying that kind of capital into smaller, less liquid companies requires a seriously well-structured portfolio. Now, here is the staggering promise of this fund, a 27.39% three-year annualized return. Just think about that for a second. Compounding at over 27% every single year for 3 years is a phenomenal wealth generation engine. This right here is exactly why people are willing to step outside the safety of large caps. But, as this quote points out, while that upside is absolutely huge, we've got to face the harsh reality of market volatility. Yes, a company growing its market cap from 500 crore to 10,000 crore can literally create 20 times the wealth for early investors. But the trade-off is unavoidable. You have to be willing to accept sharp, stomach-churning, short-term drawdowns if you want to achieve those long-term gains. Which brings us to Section 3, Risk Metrics and Distribution. Let's translate this volatility so conservative investors can actually understand it. Okay, let's cut through the jargon and demystify some of these dense financial risk metrics into plain English. Because if you want to assess long-term capital growth, you literally can't just look at returns. You have to understand the risk they took to get there. So, checking out the metrics, standard deviation shows high volatility at 20.55. That's pretty typical for small caps, honestly. But here's the cool part. The beta acts like a shock absorber. A 0.93 beta means it actually takes slightly less of a hit than the broader market. Plus, look at that Sharpe ratio of 1.0 compared to the category average of just 0.62. That tells us they are generating much better risk-adjusted returns. And the trainer ratio, combined with the fund's proven ability to generate positive alpha, meaning returns above what's expected, confirms the story. They aren't just rolling the dice. They are taking highly calculated risks that are actually paying off. So how do they manage liquidity risk with all that capital? They use a really strategic allocation strategy. While they definitely stick to their small cap mandate, they keep nearly 10% in a cash buffer and purposely diversify into mid and large caps to smooth out the ride. Remember that massive 31,000 crore AUM we talked about? When you have that much money in small caps, having to sell stocks quickly during a market panic can be completely disastrous. Holding almost 10% in cash gives them a critical buffer. Let's head into Section 4, Comparing Peers and Benchmarks. Time for the synthesis. Over a longer 3-year horizon, this fund has consistently pulled off some serious outperformance against its major peer funds and the index benchmark. While the nifty small cap 250 and the category average were hanging out around 17%, Bandhan pushed way past 27%. That kind of outperformance is the absolute hallmark of great active management, basically finding those high-growth businesses long before the rest of the market figures it out. Now, it's super important to point out a slight catch. During rapid market momentum or big rallies, that 10% cash buffer we talked about might actually cause a slight drag. Because you're holding cash, you aren't fully participating in the upside. But during extreme stress like market crashes, they successfully limit losses far better than the benchmark index. In fact, data shows that during all 6 major market correction months since it launched, this fund fell less than its benchmark index. If you're a conservative investor dipping your toes into small caps, that downside protection is everything. And that brings us to our final section, Section 5, Advantages for Long-Term Growth. Let's assess the final verdict. To really assess long-term growth, beginners absolutely need to follow these 3 exact steps to smooth out the bumps. You literally cannot look at small caps with a 1-year lens. The volatility will just shake you right out of your position. You need to mentally prepare for 30 to 50% short-term drawdowns, lean heavily on the fund's downside protection strategies, and lock your focus on a horizon of at least 5 years so compounding can actually work its magic. All right, let's run through this final checklist. These key advantages, especially their growth at reasonable prices, or GARP strategy, provide a distinct margin of safety over other options. Their PE ratio is roughly 35, while the category average is almost 44. That means they're finding great growth, but they aren't overpaying for it. Plus, by keeping their top 10 stock holdings to less than 30% of the portfolio, they ensure that if one niche company struggles, it doesn't sink the entire fund. So as we wrap up this explainer, I want to leave you with a crucial question. Is your portfolio, and honestly your own personal risk appetite, truly ready for the roller coaster reality of small cap investing? The Bandhan Small Cap Fund has proven they have the structural discipline, the downside protection, and the active management to hunt for massive wealth creation. But the final variable is you. Can you hold on tight enough during the sudden drops to actually enjoy the view from the peak? Thanks for joining me today, and I really hope this deep dive brought some much-needed clarity to your investment journey.